Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I'm going to describe about AIS versus a Form 26 AS versus ITR. Why matching all three is essential for smooth income tax filing. Introduction. As the income tax filing season approaches, taxpayers are increasingly being advised to reconcile their financial information before submitting their income tax return ITR. Various tax related resources, expert discussions, and official guidance emphasize the importance of matching information available in Form 26 AS and the Annual Information Statement AIS and the Income Tax Return ITR. When these three records are aligned, taxpayers can reduce the chances of notices, refund delays, and unnecessary scrutiny. Understanding how these documents work together can help individuals file accurate returns and avoid compliance issues. First, Form 26 AS, your tax credit statement. Form 26 AS serves as consolidated tax credit statement that reflects taxes already paid or collected against your permanent account number PAN. Key information available in Form 26 AS: A. Tax deducted at source (TDS) by employers, banks, or other deductors. B. Tax collected at source (TCS) on specified transactions. C. Advance tax payment made during the financial year. D. Self-assessment tax payments. E. Income tax refunds issued by the department. Why it matters? Form 26 AS helps taxpayers verify whether taxes deducted from their income have actually been deposited with the government. Any mismatch between TDS certificates and Form 26 AS should be investigated before filing the return. 2. AIS, Annual Information Statement, a broader financial picture. The Annual Information Statement provides a comprehensive summary of various financial transactions reported to the Income Tax Department by banks, financial institutions, employers, mutual fund houses, and other reporting entities. Information generally reflected in AIS: A. Salary income reported by employers. B. Interest earned from savings accounts and fixed deposits. C. Dividend income. D. Purchase and sale of shares and mutual funds. E. High value financial transactions. F. Foreign remittances and certain overseas transactions. G. Other reportable financial activities linked to the taxpayer. Why AIS is important? AIS offers the tax department a broader view of taxpayers' financial activities. It helps taxpayers identify income sources that may have been overlooked while preparing their tax return. Third, ITR, income tax return, your official declaration. The income tax return is the final statement submitted by the taxpayer declaring income, deductions, exemptions, and tax liability for the relevant assessment year. The ITR includes: A. Income from salary, business, profession, house property, and other sources. B. Capital gains from investments. C. Eligible deductions and exemptions. D. Tax computation and final tax liability. And E. Details of taxes already paid. Why the ITR is crucial? The ITR represents the taxpayer's official declaration to the income tax department. Any discrepancies between the information reported in the ITR and the data available in AIS or Form 26 AS may trigger follow-up actions. The tax triangle. Why reconciliation is necessary. Tax experts often describe Form 26A as AIS and ITR as a tax triangle. A well-filed return should ensure: A. Income reported in the ITR matches income reflected in AIS. B. Tax credits claimed in the ITR match Form 26 AS records. C. Capital gains, dividends, and interest income reported in the AIS are properly disclosed in the ITR. And D. Advanced tax and self-assessment tax payments appearing in Form 26 AS are correctly claimed. When all three records are consistent, the probability of processing issues is significantly reduced. Consequences of mismatches. Failure to reconcile these records may result in: first, automated notices. Third is tax department increasingly relies on technology-driven systems to identify inconsistencies between taxpayer declarations and available information. Second, refund delays. Refund processing may be delayed if income or tax credits reported in the return do not match departmental records. Third, additional verification requests. Taxpayers may be asked to explain differences between reported income and information available through third party reporting. Fourth, interest and penalties. In some cases where income has been underreported or taxes have been incorrectly claimed, interest and penalties may apply as per applicable provisions of tax law. Best practices before filing a return. Review Form 26 AS carefully, verify all TDS entries, tax payments, and refund information. Check AIS thoroughly. Look for salary, interest, dividend income, capital gains, and high value transactions. Reconcile differences. If discrepancies are found, obtain clarification from the reporting institution or review your records before filing. Maintain documentation. Keep supporting documents such as salary slips, bank statements, investment statements, or tax payment challans. File an accurate return. Ensure that all income taxes and tax credits are correctly reflected in the ITR. Key takeaways. Form 26 AS reflects taxes paid and credited to your PAN. AIS provides a detailed overview of your financial transactions and reported income. ITR is your official declaration of income and tax liability. Matching all three documents helps ensure accurate tax filing. Proper reconciliation and can reduce the likelihood of notices, refund delays, scrutinies, and penalties. Conclusion. In today's data-driven tax environment, accurate reporting has become one more important than ever. The income tax department receives information from multiple sources, making it easier to identify inconsistencies. Before filing a return, taxpayers should carefully review Form 26 AS and EIS and ensure that the information aligns with their ITR. A little time spent on reconciliation can help avoid future complications and contribute to a smoother tax filing experience. Disclaimer: this article is based on information commonly discussed by the tax professionals, publicly available tax guidance, and educational resources available on various websites. It is intended solely for informational and educational purposes and should not be considered tax, legal, or financial advice. Tax laws and reporting requirements may change over time. Taxpayers should refer to official government resources or consult a qualified tax professional for advice specific to their circumstances. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.